I have $200, and now I don't. Just like that, it's gone. Poof. On November 29th, 2011, Drake dropped the motto, which helped push the term YOLO into mainstream culture, a phrase that would later become deeply tied to the now infamous subreddit WallStreetBets. Little did Drake realize, he wasn't just spreading a slightly cringe internet slogan and a trend of double wristing watches. In reality, he was nudging society down a slippery path of pure degeneracy, one that would slowly transform the idea of a stable retirement plan into something more like an 11-leg Washington Wizards parlay, which, honestly, in today's world, both have about the same chance of ever paying off. Before all of that chaos, WallStreetBets was actually a much smaller, niche community. It was mostly made up of white-collar professionals, typically people working in finance or software, who were somewhere in that early middle-aged bracket. Back then, users would write detailed analyses called due diligence, or DD. These posts would focus on some obscure stock or commodity that they believed was about to make a big move within the next week or two, usually driven by some upcoming catalyst that seemed exciting at the time. After laying out their reasoning, they'd share the positions they took to capitalize on the idea, and then, later on, return to update everyone, often showing how it all went wrong. For people outside the markets, you need to understand that when someone talks about stocks, they mean taking your savings, buying a piece of someone else's business, and then earning from their work by clicking a button online, and then doing nothing afterward. When I explain this to people who aren't familiar with it, the usual reaction is that it sounds too good to be real and must be some kind of scam, which is partly true. But at the same time, it's also the foundation of the entire global economy, so you might as well get used to it. Now, if any of this sounds even remotely reasonable to you, forget it, because Wall Street and WallStreetBets is not about carefully maximizing returns by investing in strong businesses like Costco or Toyota. It's about realizing that there are heavily traded financial derivatives tied to things like orange juice futures, and this is going to be a screwdriver summer, my girlies. During this period in the mid to late 2000s, WallStreetBets, along with the rest of Reddit, slowly began shifting toward a younger and much larger audience as it evolved into more of a mainstream social platform. This brought in a wave of college students who hadn't really gained experience in derivative markets, but were now jumping straight into them anyway. This shift eventually led to the final moment of the original WallStreetBets era in 2019, when a user known as Control the Narrative used a Robinhood exploit to gain access to $48,000 in margin from just a $2,000 account, or, as he described it, leveraged for my personal risk tolerance. He then used that to buy around $50,000 worth of Apple put options, held them through earnings, and live-streamed himself as he lost everything. At one point, he asked WallStreetBets if he was going to go to jail and what he should do next. Another user replied with a simple piece of advice: just delete the app. This moment was quickly overshadowed as, around the same time, China was literally welding people into their apartments over what seemed like just a bad flu, which led many people to shrug it off as classic China while enjoying their Western freedoms and their toilet paper. The second era of WallStreetBets began during COVID, when its popularity exploded. Everyone was suddenly stuck inside indefinitely with stimulus checks and unemployment money that they very much needed to avoid using to pay off student debt, since that was conveniently deferred and obviously never coming back. This era ended up being one of the best periods WallStreetBets ever had, because most people entering the market for the first time weren't focused on making money or writing detailed DD. They were just panicking that the entire global economy might collapse and that we might all die. So instead of smart investing, WallStreetBets turned into a front-page subreddit where self-proclaimed financial experts in their early 20s tried to educate everyone else, and then I would read it, understand absolutely nothing, and just make a meme about it that got 10 times more upvotes. It really created this strange sense that if everything was going to fall apart, at least we were all going through it together, and it didn't even feel like you were losing money. It felt like we were losing money. Which, to be fair, we were, because actual Wall Street was busy extracting as many stimulus dollars as possible from regular people and funneling them to the wealthy. So in a way, it kind of brought things back to normal. To me, the peak of this era, aside from the memes, was that because everyone was so inexperienced, most trends started with some random person online creating a simple, convincing narrative, and then everyone would just pile into the same trade. One example was, we should buy liquor stocks because everyone's stuck at home drinking, which only fell apart because the person completely ignored the fact that a huge portion of alcohol sales comes from restaurants and bars, which were, in fact, closed. Another one was, we should buy Activision because Warzone is going to crush revenue since everyone's playing it at home, which failed because Candy Crush, Activision's biggest revenue driver, was mainly played by Chinese moms at airports, and it completely missed expectations. Another iconic moment from this period was the SPAC bubble. These were basically publicly listed shell companies created to acquire private businesses and sneak them into public markets, all while collecting massive fees and skipping the usual IPO process. This gave us companies like Lordstown Motors, Hyliion, and ChargePoint, which are now all down around 99% from their peak. And then there was my personal favorite, Nikola Motors, a company that essentially made a few 3D renders of a hydrogen truck and then filmed a real truck rolling downhill to make it look like it actually worked. At one point, it reached a market cap of $30 billion. A company with a single render was worth more than Ford. I genuinely disliked this company with the same intensity as Air Canada because the CEO would just make things up constantly, like the time he pointed at a screen in the truck and said, "This is a custom operating system we built, running on an HTML supercomputer." If that doesn't immediately bother you, that's like me saying, "Yeah, we rebuilt DoorDash, but instead of delivering food, we just cook it inside the app." My absolute favorite moment from this era, though, was a guy who bought futures contracts for crude oil in April 2020, when storage ran out and prices dropped to around negative territory. A few hours later, he sold almost all of them at a profit, except for one. He then proudly posted that his remaining contract was worth over $26,000 and that since it had expired, he had locked in that gain. Another user quickly pointed out that oil futures aren't cash settled, meaning he didn't lock in $26,000 in profit. He locked in $26,000 worth of actual crude oil that would now be physically delivered to him in Oklahoma. At the time, it was the funniest misunderstanding I had ever seen, right up there with the guy who lost everything trading ornamental gourds. Seriously, pause and read that one. I remember seeing it for the first time and laughing so hard, thinking it had to be satire. Then I checked his post history and realized it wasn't. In 2021, as COVID was starting to wind down, WallStreetBets entered its final major chapter, the GameStop short squeeze. At this point, the most upvoted post in Reddit history was about GameStop, which already tells you how massive this became. In short, a user known as Roaring Kitty posted a classic DD explaining that while GameStop looked like a dying retail company being replaced by digital game sales, that exact belief had caused an extreme level of short interest. His idea was simple. If the price started rising quickly, all those short sellers would be forced to buy back shares to close their positions, creating a chain reaction, a short squeeze. Basically, a potential infinite money glitch. Real finance professionals were quick to point out that the situation wasn't quite that simple, and that the DD had some serious flaws. But this is Reddit, and Michael Burry supported the idea, so naturally, everyone piled in. As George Soros once said, "Show me a bubble and I'll buy." I won't go too deep into the full story because to this day, almost every white-collar guy over 30 has some kind of coping mechanism for the money they lost on this trade. But in short, what started as a somewhat interesting trade idea turned into a global phenomenon. Suddenly, millions of people, basically every man between 20 and 55, were buying GameStop stock or options, and the price went completely vertical. Roaring Kitty started with a position worth about $50,000, and at one point, it peaked around $48 million. If you're wondering why everything today feels like a loot box, this is why. Eventually, GameStop reached over a $30 billion market cap, and brokerage platforms were struggling to even stay online due to the traffic. After hitting nearly $500, split adjusted, the stock suddenly collapsed, dropping limit down after limit down to around $100 because Robinhood turned off the buy button. This led to a massive conspiracy theory that still exists today that Wall Street was getting exposed by retail traders and used its influence to force platforms like Robinhood to manipulate the market. If you ask people what evidence they have, it usually comes down to, "It just really felt like it." And while losing money always feels bad, trust me, I know, you still have to be careful not to fall into what's known as trader on the way up, community member on the way down. After that peak moment, where the little guy briefly felt like they had taken over Wall Street, only to watch it slip away, WallStreetBets settled into what it is today, a large, comfortable mix of finance news and memes. I still enjoy it, but it has that feeling of looking back at old photos of yourself in your early 20s and thinking about the good old days. And then someone reminds you, that was 10 years ago, and your life is basically the same now. And you're just like, they don't know about lumber liquidators. In my opinion, the biggest cultural impact of WallStreetBets has been how it helped normalize the gamification of everything. Because underneath it all, there's this shared feeling among a lot of younger people. I'm probably never going to own a home or build a stable future, but if I throw my savings into a risky bet, maybe I can escape. Which is honestly pretty depressing, because it fuels both left and right-wing radicalization, pushes companies to add gambling-like mechanics into everything, and encourages extreme behavior as a solution. And the worst part? None of those features are even available in Canada. Now, if you use Robinhood, you might be thinking, wait, they sell my order flow to Wall Street so they can trade against me? But it's fine, right? Because sometimes they give you confetti. Well, if someone was doing that with your personal data, your phone number, your email, you probably wouldn't be okay with it. And that's exactly what data brokers are doing. But at this point, that almost feels on brand. Because somewhere along the way, investing stopped being about building a future and started feeling like trying to escape one. I guess that's just how it goes. You have $200, and then you don't.